Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Matt Battiali, editor of the New Energy Investor, published under the Mangrove Investor website, which I will link to below. Now, Matt, you were recently at PDAC, the large mining investment, just general resource conference in Toronto. And you were recapping to us a conversation that you were having within the newsletter writer area and how people were discussing the difficulty that U.S. investors have to invest and even fund junior exploration companies, mostly traded on, let's say, the TSX Venture Exchange, and then some dual listed down in the U.S., mostly on the OTC markets, and comparing that difficulty to just how easy it is for people to sports bet or even invest in some cryptocurrencies. Matt, take us through what this conversation was all about and maybe anything that we can do to change that overall narrative that just makes it very hard for U.S. investors to actually invest in junior resource companies.
Yeah, thanks for having me back again, guys. It was an interesting conversation. It was spurred by the lack of capital. So the newsletter panel were discussing, where did the capital go that used to be in junior mining? And I think that there are a lot of distractions, and not the least of which is this massive emergence of sports betting that we see in the U.S. I guess it's global now, but in 2009, during the last bull market in mining stocks, like the real big bull market, there was no competing area. If you wanted to sports bet, you could go to Las Vegas or Atlantic City, or you go find a bookie. But right now, that money, there's about $100 billion in bets that were spent on sports just in the US this year. And in that run from 2009 to 2011, that was money that was going into junior mining. Now, not all of it, obviously, because as we started out, saying it's difficult for U.S. investors to participate. But these days, it's simple to get an account and bet on sports. Like they'll give you money. You sign up today and you get $500 in free cash or $200 in free cash. And the reason it's difficult for U.S. investors to invest in juniors is because of a safety factor. They're worried that investors are going to get taken advantage of. And I see that as a very odd double standard that, we can have commercials on TV for sports betting where, these companies that are offering this, these now mainstream bookies, if you will, are making so much money they can have commercials during the Super Bowl, but these stocks are considered too risky to the point where even if you have a trading account with some of these standard traders like Robinhood or E-Trade or Schwab, oftentimes you can't buy these junior mining stocks, these drill plays that are really where there's a lot of leverage. And the idea is that there's just too much risk. So crypto, sports gambling, online sports betting, and junior mining stocks. I mean, do you see junior mining stocks as more risky than these other two things?
I mean, that's a tough question to answer because they're all risky in a different way. And I think, like we were talking about before the call, Matt, a sports bet's more of a binary bet. Something like a crypto or a mining stock or even something like biotech, they're all very risky, but you can get in and out of the stock in phases. You don't have to buy it all in one tranche. It's not a binary bet. You can layer in or layer out. You could pull your money right back out again if it didn't go the way you wanted, where once you're in a sports bet, you're in. Same thing with traditional Vegas style betting. But I think another issue that I think that's more important that you brought up is the access to be able to even trade it in the first place. You brought up Robinhood, but if you think about what happened during the silver squeeze, a lot of the Robinhood traders that were in crypto are trading options, which are also incredibly risky, were also blocked from buying most of the OTC listed over-the-counter stocks. The same thing with Webull and Stash and many of these other new online platforms that have demographics of 20 to 40-year-old investors. People complain in the mining sector there's not a lot of those investors, but literally some of them cannot buy over-the-counter stocks, even if they're on the OTCQB or OTCQX. And when we saw the silver squeeze, a lot of people wanted to buy silver stocks and couldn't. They were limited to something that was on the New York or NASDAQ exchanges. So I think we could maybe discuss that. The access to even be able to buy the stock in the first place is often a barrier for U.S. capital flows.
Yeah, I know from personal experience that it's very difficult, especially the much smaller stocks. And in my world, it was always I was looking at people, right? When you get down into the sub 30 million market cap, you had someone that you know is a successful entrepreneur, a successful mining entrepreneur. They start a new company and it's 7, 10, 12 million dollars, and a very small company, but they have projects that you like or they have a team that you like, and I want to back them. As an American, often can't. And God forbid you try and participate in a private placement as an American. The barrier to entry of that is huge, but it's not just the barrier to entry. As we were talking earlier, it's the inability to then sell your shares, act on your warrants. It's unbelievable. And it's unnecessary. They call them guardrails, but they're really not. It's more like quicksand, and so you end up as an American holding the bag while everybody else gets out.
So, Matt, is this a problem with the exchange, like the TSX venture exchange, or is this a problem more with the brokers and the big brokerage houses that do need to facilitate some of these trades?
Well, I think it's not just limited to the exchanges, right? Because obviously, Robinhood, for example, if you can't trade certain OTC stocks, that's on Robinhood. That's not on the TSX. But I do think that the fact that a Canadian company can't send their press releases to Americans, you often see on the bottom of press releases, this is not for distribution in the United States. It doesn't make any sense to me. How is limiting information a benefit to an investor or a potential investor? It makes zero sense to me. And that is on the TSE. And I'm sure at some point there was a reason that they did it, but a lot of times the logic fades with time, and it just the rules then stay in place from ennui, right? It's just it's there because it was always there, and we don't know why we should change it. And the answer to that is, well, the world has changed dramatically since you put that rule in place, and it's no longer valid. So I think there's a need for some systemic changes to all this stuff. I mean, seriously, if we're going to make buying cryptos easy and gambling on stocks or gambling on sports betting easy, why would we make the information flows for investors difficult? And why would we make buying stocks and investing in mining projects? But it's not just mining projects, it's all these juniors investing in new companies. Why would we make that more difficult? It makes no sense to me.
Yeah, Matt, I think you raised some good points. The private placement issue is a real issue for people, not just getting into the stock, but even getting out of it and waiting for the legend while everybody else has already made their move in other countries. The access to information. It's not just Canada. It's the same with London-listed companies and Australia-listed companies. They often won't disseminate their news to U.S. investors. But what's really crazy is the U.S. investing base is one of the deepest pockets that there is in the world for investing. And so the junior mining sector needs to do a better job of being internal champions to try to help more U.S. investors get exposed to it, because it's a lot easier to be a crypto investor or even to invest in biotech, because most of those are domestic and not foreign companies for U.S. investors. I want to bring up the issue again of dual listed companies. I know it's a charged topic in that if you're a small company, you can't really afford the fees to do it. So it's a non-issue for the smaller drill plays. But there is a point once a company gets large enough and has a big enough market cap, and there are some companies that have $500 million, billion-dollar, $2 or $3 billion valuations that still only have over-the-counter listings. They still don't have a New York or NASDAQ exchange listing. And there's companies that have proven they can do it in the royalty space and in the producer space. But there's a lot of companies that just flat out don't care and don't spend the money on it, and they snub their nose at it. And when you see big moves into the mining sector, when gold is moving up higher like we see this week, people want to get in position in companies. They're not going to get in the OTC stocks, a lot of them, and some firms and institutions can't. they're going to get in the dual listed companies. So we always try to have discussions with companies that are large enough about, hey, when are you going to get access to U.S. investors by getting a big board listing? What do you think of that, about championing that cause with more companies once they get of a certain size?
Yeah, you're adding costs, and I think for a lot of these companies, that's the real hurdle is you're adding the layer of requirements and fees, minimum share price. You have to have a minimum share price like for the Nasdaq, and I don't know if that's the same for the New York Stock Exchange, but I think it is. But it's also the layers of accounting to I think it's the Sarbanes-Oxley. You have to have a lot of extra layers of accountants on board as well. So there are not just the fees for doing the listing, but the requirements to maintain that listing. I just, I find it difficult. I really think that the U.S. needs to do a better job of making, and they have. I should preface this by saying that they have done a much better job of adding requirements to the OTC so that there is a layer of safety and de-risking. The old days, the pink sheets were like the Wild West of the stock market, and I think that there's still some residual hangover for the OTC listed companies that, oh, that's the Wild West. They're not a Nasdaq or not or an NYSE listing, but they've changed the rules, and so there is a little more accountability there. But you also have a lower hurdle for small cap companies, and so there are more companies, maybe not the drill plays, but you don't have to be a $500 million market cap to get an OTC listing and then get access to U.S. markets. I think that they just need to do a better job of promoting the OTC as a place where you can, as an investor, feel confident that you're not going to get, like, there's not going to be a lag in volume, so that when you buy your stock, you're paying more than the actual stock that's on its dominant exchange, or that you're not being taken advantage of on the exchange rate, or you're not they're not putting their finger on the scale when it comes to the price, so that you can actually get in and get out at reasonable prices. Once there's some level of confidence there, I think that it will be more attractive to foreign listings. But the other side of the coin is, as a former newsletter writer, I mainly wrote to Americans, and I focused on these natural resource companies, and I honestly wrote a lot about oil and gas companies because you could buy smaller cap oil and gas companies because they listed in the U.S. where their counterparts, and we had commented on this before we got on the call. Their counterparts in mining tend to list in Australia or London or Canada, and they don't get on at the time it was the Amex or the Nasdaq, and so there is absolutely a desire among American investors to get into these natural resource stocks. There is, at the moment, a pretty high bar for them to do it, and that's frustrating. It does need to change.
Let's tug on that string a little bit more, because look, there are avenues for companies to list and open up easier trading for Americans in the U.S. But yes, it costs money, different regulations, and that is ongoing year after year. But to that last point you just said there, Matt, are there enough investors in the U.S. that are saying we want to invest in these junior stocks? Because it seems like the companies are saying we want your money, we want to open up this market, but are investors in the U.S., enough of them actually saying, yes, we want access to these penny stocks?
Yeah, I think, my experience, absolutely there was. The readership of the newsletters that I wrote was always, 75,000 to 160,000 people, and that was just my little letters. I mean, there is an appetite for this. Certainly in the gold and silver space, I saw a growing appetite as as it became more mainstream. And I think that's true right now. I think lithium was very popular. We could go and look at the volumes of the few lithium companies that did list on the U.S. And I certainly think that, the uranium companies have benefited from interest among American investors. And, there have been a few, like Rick Rule he has a pretty good pretty large American audience. And he was out there pounding the table on uranium for a long time. So yeah, I think there is certainly a market. You go to a money show and it's full. There are lots and lots of people going to these things. The problem for Canadian companies is that, in order to get on the OTC, you need to have capital. And that's the hard part. It's very difficult to bring American investors into private placements, not only because of the difficulty of clearing your restrictions on the stock and the warrants, but in vetting them and making sure that they meet the rules and requirements of the Canadian stock exchanges. So, that means that you're making a market in the U.S., but you're not really raising capital down here.
Matt, I want to go back to what you said about lithium and uranium because I think it illustrates the point perfectly. When you saw the lithium run a couple of years ago, there were a few dual-listed companies in the U.S. or companies that had OTCQX or QB listings, and they garnered most of the capital. And for some reason, those companies' projects moved forward because magically they had more capital to do investing and move their projects along. Other companies that had more stranded, and some of them are still on the pink sheets or the gray sheets, even worse than the pink sheets, they didn't get any capital flows. We saw the same thing in uranium over the last couple of years. There's a lot of dual-listed companies. When you think of companies like Denison, NextGen, UEC, Energy Fuels, those companies, Cameco, they're getting money because they have access to U.S. investors and they're able to funnel it all in. When you look at a lot of the smaller uranium companies, many of them didn't move, even though uranium was moving. And that's because U.S. investors can't buy those stocks. I think the exact same thing's happening in gold and silver and has been for over a decade. So I think it's a real issue, being able to access the kind of stocks that they maybe want to get in. And so they're forced to get into sometimes larger cap stocks than the small caps. So it hurts the small caps the most. But it also means that those companies that get the capital have the best odds of moving their projects forward. So it almost tilts the scales to those companies.
No, I agree 100%. And I think you're going to see that now with the more so with the battery metals too moving forward. So the copper plays that are dual listed are going to outperform the copper plays that are isolated. And I think gold and silver for sure. There's a really robust community of gold and silver bugs in the US that love these. It's the treasure hunt story, but it's also the lure of gold, this idea that gold is money, has been money forever and will be money forever, and it'll outlive all the paper currencies. That's an attractive story. And so if you're a gold miner and you don't have access, if you just figure, oh no, I'm going to list on the TSX, and if they want me, they'll come find me, you're shit out of luck because it's difficult. And while these folks have money, a lot of them aren't willing to jump through all the hoops to go and find your company. The companies that are proactive, that take the time to dual list and market in the States are going to have more access to capital, or at the very least, they're going to have a more robust share price so that when they do go raise, they're able to raise capital at a higher price and dilute less, which makes them more attractive going down the road, right?
Fair enough. But that's the thing, right? They do have the ability to go market in the U.S., to list in the U.S. It just will cost more, but sometimes you have to spend money to open up new markets. So is this something, Matt, that maybe from an investment standpoint, do you see this changing at all? Or if you are looking at companies, do you in a way demand that they do have a U.S. listing?
Yeah, I think the more access they have, the better. And I think dual listing, honestly, I'm looking hard at companies that are dual listed in Australia and Canada as well, right? Australians really understand the natural resource market. They understand mining. They're very pro mining. And so, yeah, I think that companies that are dual listed, and certainly if companies that are willing to come into the States and market, are more attractive to me because, part of the investment thesis is you need to be able to tell your story and get more eyeballs on it, or else you're a value trap. You can have the greatest gold mine in the world, but if you can't raise money, it's going to be somebody else's gold mine. So marketing is a part of this, and it has to be. And the more eyeballs you can get on a story, the more likely you are to get more people involved, and the higher your share price is going to be.
Matt, I want to throw one more wrinkle in here too, and that is, I think because of the nature of how this has worked, not just in gold and silver, but again, with lithium, with uranium, with rare earths, a lot of investors are forced into passive ETF investing vehicles because those are things they can buy. And so sometimes what will happen is an investor will say, well, boy, I want to get access to lithium or rare earths or uranium. And they'll think, I can't really buy most of the stocks the newsletters are talking about, but I can buy this ETF that is listed in the US. And so what that does is it forces even more passive investing, which means the companies inside that ETF benefit. And if you're not in those ETFs, you don't get any love. How do you think that the trend towards more passive investing, particularly in ETFs, exchange traded funds, has changed the landscape for companies that are not in those ETFs?
Yeah, ETFs are the human centipede of the investing world because of exactly what you said. And it again, it's a finger on the scale. It's choosing winners and losers. Certainly, the road to success is paved with access to capital. And access to capital is a function of your share price and your visibility. And when you can get into some of these big ETFs, you do both. You get a higher share price and you get more visibility. The companies that aren't in those ETFs, I mean, that comes down to management then, right? You can succeed outside of that, but it's a tougher road and fewer. You're going to be much more. So as an investor, if I put my analyst hat on, companies that are in these ETFs are going to be more resilient to problems. And companies that are outside of the ETF are going to be more sensitive to problems. So in a case where you have a glitch with a company and they need to raise more money and they're in an ETF, they can do it and their terms will be better than a company who doesn't have that high a profile. And so, if you pay worse terms, that means your returns are going to be lower. And that means that your investors aren't going to get as much benefit as a company that can raise at a higher rate with a higher profile.
Yeah, good points, Matt. I don't know if we ever see this kind of trend changing here, but look, there are avenues for companies to list in the US. It does just cost more money, but it's such a large market down there, and they need to then spend time to actually market in the US. You can't just get a US listing and assume investors are going to fly into your stock. There is a strategy that needs to be undertaken for these companies to make it worth their while. We just don't see a ton of companies go down that route, but some of the ones that have, we have seen them benefit from that. It's something interesting to just throw out there, a topic for everyone to more or less think about and also look at when you are investing in certain stocks. If they do have a US listing, if you care about that, and if you believe that it could actually open up a bigger market, maybe they do have a plan to list in the US. Just something interesting for us to chat about here, Matt. Thank you very much for bringing this to our attention. We'll chat with you in another couple weeks. And as I mentioned, I will post a link to the Mangrove Investor website where you can follow along with all of Matt's commentary. Thanks for your time today, Matt.
Thanks, guys.